right, cool. So what I was thinking of doing was just going through just some top downs. So start at monthly, go through down to weekly, and then just start to look at what the daily range has been like for like the last, couple of months since that June low, and just talk about that and talk about like what I'm seeing, and obviously in light of that recent bounce that we've had in Bitcoin, because that was not really a surprise. I think that was to be expected when we've had that range compression. But I guess the question is what's going to happen next? And I keep looking at the wrong camera. What's going to happen next? And, how should we sort of position ourselves and all that sort of thing? So we'll start with the monthly. And I guess, you guys are here. Like, does that sound like something interesting? You'd like to just sort of run through that, and obviously I'll keep an eye on the chat, and if anyone has any questions, just shoot them through as we go, and just sort of see what happens. All right, cool. I'm going to assume the silence is that everyone's happy with that option, and we'll go for that. Okay, cool. So really super simple. This is purely sort of how I'm looking at Bitcoin at the moment. So this was the all-time high from the previous cycle. So this is that December high. So it's at about, 19,600 or something like that. Cool, thank you. So this is like a really important level, and you can just see, you draw this across, and you can really clearly see, without drawing heaps of lines of resistance, support, or any of that sort of thing, about just how key this level has been historically and even now. So you can see in the initial part of the run before we came in 2021, you can see once we broke through that level, the market just took off. And this has almost essentially all been like a big deviation. And then as the markets come back down, to more recent levels after we hit that all-time high in December, you can just see how respected this level has been. So, here we poked through, but we didn't close below. Again, we poked through, closed above. Same again. And then this was the first candle here, monthly candle, to close underneath. And you can see the current monthly candle, we're just kind of sitting above that level. And obviously we've got about 4 days to go, and that will sort of determine where we finish. But you can just see how critical this level has been. And the area that I've sort of been thinking about long term is this, bullish fair value gap we have down here, which was, formed late last in 2020. And this is sort of where I sort of am, I guess, thinking that the market could potentially go down to. So historically, when the markets pull back, it's done about 85%. So you can see, if we go from the high and just pull this down, this is obviously pretty rough, but this is just, I guess, a sort of high level as I draw down in terms of my thinking about what could happen and where we might be going. Is if you go down to like 85%, you can see that takes us to about 10,000. Now, I don't necessarily know if we would go that low, but it's just something worth keeping in mind that previous pullbacks from the high to the low have been about 85%. So if that was to happen again, there's potentially still more downside. Now you can see we're obviously, flirting, if you like, with this previous all-time high level. And just over the last, couple of months, we've now painted these relative equal lows here. And whenever we have relative equal lows, it just becomes suspect that they're going to be potentially breached at some point. Now, if we go down onto our weekly chart, we can see this formation in a little bit more detail. And you can just see how, this all-time high has really acted like a magnet. As price has sort of gone underneath it, it's come back up. As it's drawn away, it's sort of pulled back in. And if we look at the this weekly chart, this is one of those really typical formations, that's come from that mentorship program from IC2. I know lots of you have been following his teachings like I have. You'll see this pattern. So we've taken liquidity this way, the market's then broken to the downside. We have this big displacement. You can see we've broken market structure just here. I don't know if I've drawn some of these out already, but I'll draw them now so that makes it clear for everyone. So you can kind of see we break market structure just there. So I'll give you some insight into how I play around with my charts. And you can see we've got our two imbalances here. And then obviously if we're applying, ICT's concepts, we'd be using this lower imbalance. Oh, did that badly. Wrong shortcut. Then, we'd apply the imbalance here. And so we've got a bearish fair value gap here. And you can just see quite clearly that, we broke market structure. We've taken out this liquidity with this push up. We've got our displacement down. We've created a new low. And then the market's traded back up into that imbalance. You can see how well it's respected that. And then it's traded away. Now we've drifted in and around this all-time high level. And that obviously sort of takes us to the present day. So, our overall sort of top-down framework, we're still very clearly in a downtrend. We've got, high, lower low, or, we've got a low here, lower low, lower high. Even if we're just super rough about it, that's very clearly a downtrend. And so there's no real expectation at the moment that this should have changed. And you can see we're trading, well within that zone. We've touched into it and now we've traded down. So if we draw in even closer and go into our daily chart, you can see we've just got this, quite ominous fair value gap resting over the top of the market here. And you can just see even clearly how each time we've traded into it, the market sort of pull back and come back down towards this all-time high level. Okay, so now if we look here, if we just sort of look really more specifically at these daily levels, now I'll see if I can bring in some of my previous drawings. Don't really want to bring too much shock and awe in. Let's just see what we've got here. I've drawn heaps of stuff. Maybe I'll just completely redraw them again. So one of the things I do when I'm using some of ICT's concepts is I'll layer, fair value gaps across different time frames. So I work my way top down. So we've got monthly, weekly, and now we're on daily. And so you can see we've got another fair value gap here. So if we take this structure as this displacement down, as we've broken market structure, we take that first imbalance and draw that across. You can see we build additional confluence in this zone, and you can see as the market traded up into that, it was weak each time it went in. It reacted and came back, traded up, reacted, came back, traded up, and eventually you can see here this particular move took out all of the liquidity here, all of the buy side liquidity resting here, and then reacted strongly and traded back downwards. And so you can see this has happened a number of times. So we've got another fair value gap just there, another bearish fair value gap right there. So you can see we took the liquidity out of the market here. So we had that push higher, took out that buy side liquidity. We then had our displacement lower, and this displacement broke market structure right here. You can see that there. And then afterwards you can see we've traded back into it a number of times, and you can just see how we've got this confluence. So that's our weekly, this one here, that's our weekly fair value gap that's sort of sitting behind. We've now got a daily that's resting over the top, and you can just see this additional area as the pink starts to get a bit darker creates that additional confluence in that zone. So you can see prices reacted to it each time it's touched it and then dropped away. And then it's come back in. So you can see we've come back down to the downside this way. We've taken out in this move, this push down took out all of the stops that were residing this down here. So all the sell side liquidity here, this particular move took all them out. So then we'd expect a reaction upwards again, which is exactly what we get. And again, it comes back into this area, which has a lot of confluence now building from that weekly and daily overlapping fair value gaps. And you can see the market reacts really strongly to that, pushes it right back down towards this all-time high level, and then we trade lower. And you can just see, this is what I've got that title in the comments about the meat grinder. Like, you can just see this contracting range, just trading to the top, trading back again, trading up. And then, we had the CPI that was released just around here, and you can just see how the market whipsawed up and down. And then we've had this rally here. So that's sort of how I've been looking at the market recently. And you can even see if we look at just this move here, there's another fair value gap which has been painted there. So you can see we have that push higher. So we have all this buy side liquidity, relative equal highs here that are taken out in this move. We get that strong reaction downwards, and you can see the market trades down lower, lower, lower. We eventually get that spike lower, which breaks market structure, and again that move downwards has taken out all of the sell side liquidity that would be residing down here, and then we get not quite a strong reaction, but you can see we've just sort of hugged the bottom of this fair value gap that's formed off this move, and now we've finally traded up into it now. So this has kind of brought us right to, I guess, the current day, and yeah, the question is well, what happens from here? And so when I look at the market at the moment, it just feels like there's still a lot of overhead weight. And if you've watched some of my market updates, you'll know that from a macro perspective, I'm pretty bearish on the market. And there's just some interesting, I guess, insights I get from looking at some of the price action here. So the first one is this price action here. So you remember this was the June low, and this was the one that scared everyone. We'd already had this massive capitulation downwards, and then we had this building from those lows in June. So you can just see how neat this rally was. So a high, low, higher high, higher low, higher high, all the way up to this point. So this was a very almost like mechanical rally, and that was pretty strong. So that was quite interesting. We traded up, but then again we came into this these fair value gaps, so this weekly and daily fair value gap just sitting up here. So we had this confluence in this region, and eventually there was just too much strength, and you could see it took a lot of effort. These moves was a lot of effort for the bulls to push these up, and then just each time there's just a smackdown from the sellers each time. So that was quite interesting. And then you can see once we sort of ran out of power here, the market sort of collapsed quite quickly. And then again, you had the same sort of thing again, a lot of work to get up here, and then just very quickly it was all given up again. And now I've just had, pretty much chop until this move here. And so again, the interesting thing, not that I really pay too much attention to crypto Twitter or anything like that, but just sort of anecdotally from what you see there and what you see in some of the articles, and if you watch any of the finance reporting on YouTube, the amount of fervor around the move that we've had here is disproportionate to the actual size of the actual move that we've had, where this particular move was far more impressive, but people are far more excited about what's happened recently, which I think is a bit of a red flag, because really the end of sort of the bear market, if you like, there's this sort of saying that the bull market starts when no one's on the bus, and it just feels like way too many people are wanting to get or thinking that they're getting on the bus here, and really what you need is absolute despair, where people they just don't care anymore. They don't watch their screens, they don't watch the news, they just don't care. And so I just don't really think we're there yet. I think we've got more time to go. And so one of the things that I've sort of noticed, and just sort of looking at the charts more and more, trying to understand, I guess, where we are and where I think we could go. I'm just going to take this off and we'll put this range on. Now, if you watch other, finance or trading YouTubers, you'll see a lot of guys will talk about ranges, and they'll trade from, level to level. And, that's certainly not wrong. And I think a lot of that, underlying concepts also works well with a lot of, ICT's principles as well. So when you overlay, a range. So the range I would be looking at would be, from the June lows here. So I don't use the wicks, I use the open and the close. So the range would be from here to here. And if you run that across, you can just see how neatly that kind of works. And interestingly, that all-time high, that purple line here, effectively creates a 50%, so half of the downside of this larger range you can see in here. And so, if you apply some of ICT's concepts, in terms of, the first one, and I think the most important one, is when we take liquidity. So you can see this move that we talked about earlier before, we've gone up into these fair value gaps here. You can see we've come out of the range, we've taken out the liquidity, and then we've come back into the range and gone straight back into the midpoint here. So, very classically, I guess, we've gone from top of the range to the middle of the range, consolidated at the middle of the range, and then gone down to the base of the range. And so if you watch lots of the other trading YouTubers, this is how that they will be trading these ranges. They'll be looking to go long at support, so at the base of the range, and they'll be taking, maybe a first take profit here and then another one here if they were going long. They'll be looking at going long, taking some profit here, seeing what happens, hoping that it will go to the top of the range and then exiting there. And the sort of risk management view is that you take some profit here, you might roll your stops forward, or you leave your stops here and then take your balance here or something like that. So you can see those concepts still work quite neatly with ICT's concepts, and that's sort of partly what I do, is that you look for these ranges and then you look at taking your positions when the market takes liquidity out of the market, so say to the downside. So like here, that's probably not a good example actually, but say here, for example, this move has taken all of the liquidity out because we've taken out all this sell side liquidity. So you'd be expecting a move from here. And so if we zoom into an area here, for example, we can even do that if you guys want, for a shorter term trade, for example, because I don't think the setups on the daily have been very good bullish ones, but let's just sort of have a look and see if there's something there. I mean, this is probably not perfect, but we'll have a, conceptually it's kind of right. Just clean that up. The 15-minute was a bit better. So again, this is not really 100% technically right, but you'll kind of get the idea. So, you can see this move, we take out that liquidity, and then we'd be looking at a fair value gap to form after we've taken out that liquidity and get that displacement. So we don't really get, you've got a fair value gap here, so there's our 3 candle formation there, but we don't really have a break in market structure until, significantly further ahead. But you can see that if we say did have a break in market structure there, there's obviously not one there, but if you did, that could be how you would enter that trade, for example, if there was a break in market structure, because this isn't applying the rules. You can see how we trade into it. You're at the bottom of the range, and then you would be targeting, up here, or, in this case, that's probably too big a move to really be able to expect to profit off that. But, you would target up into the range, and say at the base of this consolidation area there. If we go maybe, let's try like 30 minutes or an hour and see if there's a setup there from that. So we're going to get one that's actually technically correct. All right, this is a bit better. Okay, so we'll just delete that out. And so this is more technically correct. So you can see this move, we've taken out the sell side liquidity with this run downwards, created this significant low. Market's consolidated for a little bit, and there we have our fair value gap formation happen here. So you can see you probably use this move here. So you can see we break market structure just here. So this is on a 30-minute time frame. So we can see we get our move upwards. There's multiple imbalances here, but we take that first one. So you get your entry almost straight away. Just there, you'd have your risk, probably just below that swing low there. And you could target back to that all-time high. And that's a pretty easy 3-hour return. So, that's an example of how you could have traded and how you can trade into the range. And so you could have, in this example, take a partial there and then try and aim, for the midpoint of the range. So that's sort of how a lot of people trade. That obviously would have been, a pretty fantastic trade. Probably would have been a bit scary to take it there just because everyone was expecting, some kind of capitulation. So some people sort of asked about going down to lower time frames. So I hope that sort of helped a little bit with, people who are interested in trading that way. I personally, other than trading on those really low time frames, like using the ICT framework from the mentorship, I haven't done any sort of swing trading on Bitcoin at all, just because I just don't feel very confident with this contracting range. And I'll show you what I'm sort of worried about when I look at the way Bitcoin is trading at the moment. So I'll just take everything off. And, the thing that I think about when I look at the way Bitcoin's trading at the moment is if we go back to, the bear market in 17 and 18. So if I just copy the range, say from here to about here, and I just drag this over, and just have a look at this. You guys tell me what you think and whether I'm making this up or if this sort of resonates. And just because obviously this has happened in the past doesn't mean it will happen in the future. But there's that old saying, history doesn't repeat but it rhymes. And if you look at this is something I think is worth paying attention to. So it's obviously not going to be perfect, but it's pretty close. So if I overlay, so remember this is I'm just going to take this into the center and zoom in. So the blue is obviously from the bear market, and this is what people call that, great halving, where the market was trading at about 6,000 and then it broke down and went all the way down into the 3,000s. And so that was obviously an amazing buying opportunity for a lot of people, but a lot of people just, were devastated by it. And this is sort of what I was talking about just before about, there's still a bit too much optimism for the bear market to sort of be over. People need to be, really sort of distraught, I guess, or devastated by it for it to be finished. I've seen enough cycles to sort of know that it just feels a little bit too positive yet. So yeah, so if we overlay, you can kind of see, and the things that I'd point out. So if I just draw these up, so what they have in common, I'll do it in pink so it stands out better, is they're both trading on this range and had tested it, many times before it finally breaks down. So the same thing here, trading in, it's obviously very rough. We haven't broken through yet, but trading along this particular level and testing it many times. So it's the same sort of pattern. You can see we have a rise up, so we have here, so that's number one. And then the market retraces that move. Then we have another one, another push up, number two, and then the market retraces that move. And similar it retraces the move quite quickly. So where this was a little bit more orderly, this retracement of that move is more sudden, and you can see it happens in like 2 or 3 candles. Again, happens in a couple of candles here. We then have some consolidation, and then a push. Sorry, that's 3, not 1. Can't count. And again, so you get another little push here, 3 again, consolidation, and then eventually that range gets lost. And so this is where we are now. So this is where we are here. And so this is what I get a bit concerned about when I look at the way the market is trading at the moment, is that we could lose this range again. So if we lose these gains quickly again, so similar to here, where we lose it in 1, 2 or 3 candles, and we come back down to that all-time high level and we consolidate, I think it's just a matter of time before we get a leg down, and then we start to challenge that $14,000 to $12,000 range that I was talking about before. So that's sort of what I have seen, and that's sort of what I'm concerned about. And so I don't know if that makes sense to you guys, if you've kind of heard something similar to that before, or if maybe that's new. But that's something that I'm looking at and just keeping a close eye on. And you can really see this if you go into the chart. So I'll just get rid of that, and we'll go back to looking at this range again. So we'll look at this range. And so the way I think about it, if I'm looking for a bullish continuation, if you like, what we need to see is we might get a bit of consolidation here and then another push up. And you really want to, if you're bullish, you want to see this high taken out, and ideally another push up to here and this one taken out. Certainly if we get up to this level around 25,000, you start to get a change in market structure here. This is like a bit iffy if it only gets up to here, but if it can get above this level here, then that's when we have to pay attention as traders, because clearly something's changed in the market when we start to take out this sort of more significant high here, and we could get higher prices from that point. And keeping in mind that this move to the downside that we've had, all this inefficiency that's being created on the downside as the market's fallen, when the market comes back up again, it can feel that inefficiency very quickly. And so that's the thing that we could see, made that a bit fat, as we come up into this level, it could feel this inefficiency in quite quickly. You'll have stops like we had here, lots of stops. That's why this move was quite sudden. Apparently there was like about $1 billion worth of positions liquidated, and so that would have been a lot of fuel as this range consolidated, which has then rocketed the price up from this 19,000 to 20,000 level in such a short period of time. And the same thing could happen again as we start to take out any of the stops that are sitting above these levels. That could really accelerate a move higher. And again, we've got all this inefficiency, and so you could get quite a sudden move to the downside, and we're back in these 30,000 levels in no time. So that's definitely a possibility. I guess the thing in my mind is that the bulls have a lot of work, I think, to break through this really tight range that's formed. And we obviously have the fair value gaps we talked about here, these bearish ones, which are keeping price down and have kept it down this whole time. It's not to say they'll last forever, but they've certainly been working perfectly so far, and so I don't really expect that to change. Excuse me. And just with the macro overhang, I just don't really feel like there's any real reason to be bullish about where the broader economy is, or where the markets are at the moment. So that's sort of my feeling. And as I said, I think the big risk, if you are bullish on the market, and everyone's entitled to their own views. I'm certainly not going to challenge anyone if they have a view either way, if they've got good basis for it, and there's certainly some basis for it. If I was bullish, if I see a retracement back down to this level, I think that's really bad news. I think if you are bullish and you see this whole move get reversed very quickly, then that really puts a big hole in the the bullish case, I should say. And if we come back to that all-time high level, it has to hold. If it doesn't hold and we go below it, let me just pull that up. You can see it here. So if we come underneath that, and then that starts to act as resistance again, you can kind of see what happens. Just while I'm mentioning that, I'm just going to draw this, so we'll do it in pink. So if you look at what's happened, so from the all-time low here, or sorry, the June low, to about here, if we draw that out, being very generous, that was the range. When we took out the liquidity here and then we traded down, we came back into the midpoint of the range all the way to the end. So if we extend this forward, this is now the new range here. So you can see we've stepped down, the range has stepped down. We've come to the top of the range here. If we extend this out, we lose that, and now the range has contracted again. So you can see how we're stepping down each time. And so if we extend that out, that's exactly where we are right now. And so if we lose this range, if we can't break through the midpoint of this range, and so we lose it and we come back down to maybe the other end of the range and we just consolidate here, then I think what you're seeing then is that, I'll just change the color, is that the range has changed again. And so it's contracted even more. And that just lends, I think, even more weight to that case that I was talking about before, replicating the halving from 6,000 to 3,000, is that this just gets eventually lost. And so that's sort of my hypothesis about what I think could happen. But as we know with Bitcoin, where you could get a really savage up candle and we're all of a sudden there tomorrow. That's entirely possible, and then the next day we can be there. So those things are definitely possible, but I just think in terms of what I'm seeing in the charts, and I think about what's happening with the macro, the picture's quite clear. And I think, as I said, if you think about how excited everyone's getting with this, very meager move, it's not very much to ask from a bullish case to reclaim that all-time high level and trade up into the midpoint. In any sort of normal scenario, moving from the bottom of the range to the midpoint of the range wouldn't really be that big a deal for most people. You'd be expecting it to trade to here, or potentially come back. You'd be taking partials here, knowing that it could do either of those things, and that's really where we are. So I think there's probably arguments both ways, but I think the case that I laid out with this descending range, I think is the strongest one. And in terms of from what I've seen so far, and certainly the next day or two is going to tell us, like if we lose these last 2 to 3 days of gains just here, and we retrace all of that move and come underneath that previous all-time high level, I think that's a bad sign for the bulls, and I think that just lends more weight to that case I have that we're going to have a constriction in the range, and then we'll just lose that range at some point, coming into the end of the year. So that's sort of what I'm thinking about Bitcoin. It's probably a bit doomerish, so I apologise for that. But in saying that, I do think there is a case for, if you are bullish, there is a trade to be had there. You just need to understand where you're wrong, and it's obviously easy to put an invalidation in there. If you're going to be going along here and aiming for here, and then your next TP could be there. An invalidation is going to be if we kind of lose, I guess, this previous all-time high level. Going short in this market in Bitcoin, I think is tricky, because this is definitely possible, but it could still, even if we make it to the top of the range, we could just then, take out the buy stops, the buy side liquidity up here, and then just come back down again, consolidate here for a bit, trade to the middle of the range, and trade back down again. That's also possible. So it's a bit of a tricky time, and I think, there's not necessarily a rush if you are wanting to play the short side. If we get a move down, into these levels, if we break and we start to challenge these previous lows, the market will move, I think, pretty quickly. And equally, if we are able to take out this level up here, that's when, if you're bullish, you can be looking at this and going, okay, well, this is a time when I can start to be more confident about getting involved. We need to go above that range. Your invalidation is going to be underneath, and you're going to be targeting up here. And again, if we do get up here, this is way too thick. If we do get up here, same sort of thing again, we'll be targeting the highs here. If you get a consolidation, we could easily go again. But if not, and it falls, well, your invalidation is, is just above that. So, sorry, if you're going long, I should say, your invalidation is going to be just below that. Equally, if you wanted to go short from here, same thing. So, there's plenty of ways to play this depending on what your view on the market is. That's all I got, guys. So I hope that was all right. That was my first live stream, a little bit of a data dump, and you probably got a little bit of a scary insight into what goes on in my brain when I'm looking at charts. But happy to do some questions, and hopefully I can answer them. Okay, so Way of Trading asked about the Asian trading range and the London range. So these are the kill zones that ICT talks about. So I'll just go into a 15-minute chart, and I'll mark these up so we can just see them more clearly. So the first thing you need to do is make sure you have your trading view, if that's the platform you're using, set to New York time. That's just going to make everything much easier. And then you want to mark out your zones. So you obviously have midnight New York time, so that's going to be, just say, right here. So I'll just mark that up. So that would be midnight New York time, and our Asian trading range is going to be from 1900, so 7 p.m. to midnight. And I just have these templates all ready to go. So that's my Asian trading range from, so as I said, from 1900 to 2400, so from 7 p.m. to midnight. And then there's a gap for the London Open. So the London Open is then from 2 a.m. in the morning New York time to 5 a.m. And again, I've got another template that I just used for that. And I have those there. And then from there, what I would do is I then mark out my midnight open. So that's going to be just here. And I draw that out in time. And again, I've just got another template for the midnight open. Okay, and then generally what you would do, it's a bit not very clean, this particular chart, but if I was trading the London Open, I'd then draw across my high of the session and my low of the session, and I'd be looking for, trading. So if I was going to take a short trade, I'd be looking for the market to go below the midnight open, trade up into the midnight open, take out the buy side liquidity from the Asian session, and I'd be looking to go short in the London session. So that's sort of how you would roughly do that. But you'd also look back to any significant highs or lows from previous sessions as well. So any liquidity that's taken, if we have a push down and take those out, that again can be a trigger. And what I've found in my trading is, say for example, if there was a significant low made in that Asian trading range, and London takes that, but then there's also another, significant low from a previous session, and London takes that as well, then that's going to be even more powerful a setup. And if you remember ICT's teachings about power of three, often you'll have the low of the session painted, or the high of the session painted in London. And so, if you get your low, this is where you're going to have your accumulation before you have your manipulation. And then in the next Asian trading session, which is going to be at the end of this day, so you could then mark it out here. And I'm actually going to cover this in my next vlog video, where I go through the full logic of the Asian trading range and the London Open that I've been testing. But I'm happy just to quickly do it now. So, for example, if the low was painted here in London, if you think about your power of three, you've got your daily candle like that. This is super dodgy. So the market would open here. So we've got our open, and then the market trades down into London. So this is where we're getting accumulation happening here between the open and the low. So say the low gets painted in London, then we'd expect that we're going to have the high get painted at some point in the rest of the session. So maybe in New York, maybe even in Asia. And then the market is going to obviously hit that high, and then we're going to get distribution between the high and the close. And the close is obviously happening at the end of the Asian trading range. So we're going to expect distribution to be happening here. So for example, and this is what I've found, is when this power of three concept works really well, I've gone long in the London session and had a good trade there. And then I've been able to go short in the Asian session and have another good trade there. Maybe not as good. I might get, between say 2 and 3 hour return in London, and then I might get between say 1.5 to 2 in Asia, because you just don't have as much time and generally don't get as much of a move. But you'd be long here and then short here, and as I said, then you're just riding the distribution under the highs as we go into that Asian trading range. So that's sort of how I've been trading it, and that's how those ranges work. So I hope that answered that question. Order blocks. Okay, so as you'd know from the mentorship, ICT's been sort of dripping out his order block theory, and so I'd love to say that I'm an expert in it, but I don't know if I don't know if that's necessarily true. But basically, so if we look here, for example, this would be the order block here, from my understanding, just here. So we have this down close candle, we have this up move, this breaks market structure, and you can see, if we just draw that order block out in time, you can see how that has acted as price has come back into it. It's then reacted to that order block. So it's that whole down close candle, but it's associated with this imbalance. And so that's the key thing. When I first learned about order blocks, it was always, it's the down close candle before the up move that breaks market structure. And that's not incorrect, it's true, but it also needs to have this association with the fair value gap, with an imbalance. So you can see we have our 3 candle formation here, so 1, 2, 3, and the fair value gap is here. So that whole zone is a fair value gap, a bullish one. But we've also got an order block which is associated with it as well. And you can see it equally well creates a reaction with price when the market comes back into that zone. You can see very clearly that it reacts to that. So that's my understanding of how order blocks works. Yeah, I'm sure there's probably a bit more nuance to it than that, but certainly at a high level, that's how that works. And you got to remember, you can also have them consecutive, so you might have a number of candles. I'll see if I can find something on the chart which looks like that. You never find something when you want it. Let's try a different time frame. Okay, here we go. So you can see we have these consecutive up close candles here. So again, there's our bearish fair value gap here. So it's our 1, 2, 3 candle formation here, and we have this big displacement. We've broken market structure just there, and so that creates a fair value gap here. Now in this instance, if we draw across, you can see it actually gets traded into all the way over here, but associated with that is there's also these consecutive up close candles here, which forms an order block. So if we just drew that out in time, all the way over to here, that's so rough and dodgy, but you can see, so let's do it in TradingView, it might be a bit cleaner. Yeah, okay. So if I take the bottom wick, and with order blocks I use the whole thing, so you can see there's the top. So this is a bearish order block because they're up close candles before we have this down move. Breaks market structure, has an imbalance sitting in it. We've got our fair value gap formation here. All of the requirements we need for our fair value gap. So we've got our break in market structure. It looks like we've taken the liquidity to the upside there. There's relative equal highs there. And if we draw this order block, I should say, out in time, you can see it takes a long time, but the market eventually trades up. You can see it reacts to it once, pulls away, reacts to it twice, and then drops away again. So it works very similarly to the fair value gap, but it can often be a little bit more precise. So you can see that's obviously a big zone, and it's often why if you use a limit order to go into your fair value gap, you can often use where the market structure is broken as a tighter entry. I've played around with that a little bit. I don't have super good data on that, but it's certainly something you guys could try out in your testing and see if it works. It certainly has worked for me. Obviously sometimes you do miss a trade because sometimes you'll just get the market will trade very into the very shallow end of the fair value gap and react to it. So that's just part of learning your system, and it can just be what trading's like sometimes. So I hope that answered a little bit of the questions around order blocks, and hopefully it was mostly correct. Alright guys, it's almost 11 o'clock at night my time, so I'll just give a few more minutes for any last minute questions. Thanks everyone who dropped into the live stream. I know it was completely impromptu, there was no advance warning. This was partly a test, so I just wanted to see if it would actually work and if anyone would turn up, and it kind of worked and people turned up, so I think that was pretty good. And I think next time I'll just plan it a little bit better and hopefully have some of the audio and everything a bit better dialed in. I haven't tried out my setups on FX yet, Alan, but I have definitely been thinking about it. If you've been watching some of ICT's videos, he talks about he's expecting that FX will be the market that he goes back to soon. That we'll start to see a little bit more volatility, I guess, there, or the markets will clean up a little bit. So certainly I've been looking and been thinking about doing a little bit of testing on maybe the euro, and just trying out maybe a couple of other pairs, but But definitely, I think there's definitely a place in the system for FX as well. Because one of the problems is, compensating for paying the fees, especially with crypto. And so, it may necessitate going to trading FX instead to try and minimize some of those transaction costs. Because I find in crypto I have to use limit orders as much as possible to keep those fees down. Otherwise, trading on those shorter time frames in and out quickly can be heavy on the fees, and they can obviously eat into returns quite quickly. So that's something I'm definitely looking at for sure. Cool. Well, if you do, Alan, just let me know. That'd be awesome to sort of get some feedback on what other people are experiencing. Already in the comments, I've heard some people are trading that London Open and doing it in a very similar way to the way that I've been showing it so far. So that'd be awesome. FX is foreign exchange. So currency pairs. So, Euro, US dollar, Aussie dollar, US dollar, pound versus the dollar, also called cable. I think I'll do more live streams. What I'll try and do is actually schedule it so that anyone who does want to watch it can actually plan to watch it rather than just hopefully be here when I do it, because that's less editing for me. I don't really like editing very much. I'm trying my best, but it's not my strongest skill. Thanks, Alan. I appreciate that. Alright guys, I might leave it there. Thanks so much for turning up and participating in this first live stream. It was pretty fun. Hopefully it was coherent. I felt like I rambled a little bit, but maybe you get better at these things over time. And I hope to see you guys in the next one. So again, thanks for coming and thanks for watching, and thanks for being active in the chat. I really appreciate it. See you next time.